My name is Andy Moon, co-founder and CEO of Reunion. My colleague Billy Lee and I have been leading clean energy financings since 2006, including some of the earliest tax equity and project finance investments in the solar industry. We formed Reunion in 2022 to focus exclusively on facilitating the purchase and sale of clean energy tax credits. Reunion has worked with dozens of major Fortune 500 corporations to purchase over $2.5 billion of clean energy tax credits so far in 2024. I'll note that most tax credit buyers we work with are new to energy credits, and so we work with them from start to finish, identifying high-quality opportunities, performing due diligence, and negotiating commercial terms. On the flip side, sellers work with Reunion because we work directly with these vetted tax credit buyers, which maximizes the speed and certainty of closing. Today, we're very excited to have Keith Martin of Norton Rose Fulbright join us. In the world of renewable energy finance, Keith really doesn't need an introduction. He has led an impressive volume of renewable energy finance transactions, and the industry very closely follows his market observations and insights. So today, Keith will be presenting his trademark What's New presentation to this group, which includes some of the latest observations on clean energy finance and markets. With that, I'll hand it over to Keith.
Andy, thanks for that introduction. And Dennis Cook will move the slides. So if you hear me say next slide, that's what's happening. So Dennis, here we go. It's the last day. If you can just hold on for another 24 hours, Sanjay Gupta on CNN told Casey Hunt a couple days ago that about 70% of Americans are feeling stressed out over the election. Next slide. Trump has said he will terminate the Inflation Reduction Act. He can't. It requires an act of Congress. Most lobbyists expect the focus next year to be on extending the 2017 Trump tax cuts to and then to cannibalize parts of the Inflation Reduction Act to pay for it. Next slide. House Speaker Mike Johnson told CNBC at the end of September that he expects the Republicans to take a scalpel to the IRA rather than a sledgehammer. However, if there were a big Republican sweep in the election tomorrow, so that Republicans end up in control of the White House and both houses of Congress, then a hammer is more likely. There will be a lot of testosterone in the room. The process, however it works, is expected to take most of 2025 to play out. Next slide. If Harris wins, look for a corporate tax rate increase. She wants to increase the corporate tax rate from 21 to 28%. The IRA will remain a strong tailwind. Of course, Trump is proposing big tariffs. He just proposed another one this morning on Mexico of 25% unless they stop immigration into the U.S. Harris is not as big a fan of tariffs, but she's not a free trader either. Next slide. Congress faces a serious math problem. Even the Democrats want to extend part of the 2017 tax cuts. The cost to extend all of them would be $4.6 trillion, and Trump has promised new tax cuts on the campaign trail. As of about 10 days ago, he had promised another $7 trillion at least, so that would be $11.6 trillion would have to be found to make up the cost of these tax cuts. That's a 10-year number. That's how the budget calculations are done. So repealing the entire Inflation Reduction Act would raise $633 billion, according to the most recent re-estimate of the IRA cost by the Joint Committee on Taxation. That re-estimate was in June 2023. You can see the huge gap. Next slide. This has led to discussion in Washington about whether tariffs can close the gap. Trump has proposed lots of tariffs on the campaign trail. At a minimum, he wants a 10% across-the-board tariff on all imports. He's also threatened China with 60 to 100% tariffs, as high as 2,000% on Chinese electric vehicles. Martin Sullivan, who is a widely read economist in Washington, he's an economist whom policymakers read widely, estimates that a 10% tariff would raise $3.97 trillion over the 10-year budget window. That assumes that imports will grow through the 10-year period at the same rate as GDP growth projected by the Congressional Budget Office. Of course, tariffs cause substitution. So people would not buy imports, they'd switch to domestic products. That would reduce the collections. To put this into perspective, U.S. tariff collections in fiscal year 2023, last year, were $80.3 billion. If you multiply that by 10, $800 billion would be the equivalent. Next slide. Tax equity investors are already demanding more expansive change in law protections in tax equity documents, looking ahead to next year in a big tax debate. The most common provision we see is the tax equity investor gets a repricing at the end of February 2026. That's the assumption among the lobbyists that this process could take as long as that to play out fully. Tax insurance policies usually exclude coverage for losses caused by changes in tax law, but you have to read the exclusion carefully because they vary, focus on what the effective date of the exclusion is for whether coverage would be barred. Next slide. Many developers have been starting construction this year to Trump-proof their projects. It's a little like NATO trying to Trump-proof European defense from a Trump administration. If you do start construction by the end of this year, then tax credits can be claimed on the projects under the current tax code sections. These ITCs and PTCs on renewable energy projects are moving to new tax code sections after this year. If you start construction this year, it doesn't take very much to start for tax purposes. It gives you the option to claim the tax credits under the current tax code for projects that are completed by the end of 2028. It also locks in a 40% threshold to claim a domestic content bonus credit. You can get to at least 40% domestic content, but it only works for projects, as I said, that can be completed by the end of 2028, unless the projects are on federal land, in which case you have 10 years. Offshore wind, also 10 years. Next slide. A number of issues remain in play in Washington as Biden rushes to get out remaining guidance under the Inflation Reduction Act. Next slide. One is the IRS simplified the calculation of the domestic content bonus credit in May. That's an extra 10% tax credit. The market has been slow to feel comfortable pricing that into financings. But as of May, it has been moving forward. Treasury has decided, at the urging of two solar panel manufacturers, to create a new line in a table it published that lets you calculate the domestic content easily. New line for solar wafers, which would make it harder to claim domestic content on solar projects. Right now, if you look at the table for a utility scale solar project, you just look down the list of major components there and identify those that are US made. You add up the percentages next to them. If you can get to at least 40% currently, you get a bonus credit. Solar cells are 36.9%. So you don't need much beyond that. But what the Treasury has tentatively decided to do is to split that cell line so that part of that 36.9% would be attributable to wafers. Next slide.
Sorry, Keith, just to ask one clarifying question. When you say they've decided to make this change, should we expect to see that in additional guidance at some point?
Yes, we're expecting another notice on domestic content calculations by year end. It will add to the table, which simplifies calculations, not only onshore wind, solar, and storage, which are already there, but also hydroelectric, probably geothermal, and then it'll make this change that I've described.
Got it, thanks.
Next slide. Some tax equity investors and tax credit buyers are pushing back on claims that projects on brownfield sites qualify for another bonus credit called an energy community bonus credit if the amount of pollution is insignificant. So we've seen lots of brownfield claims. All you have to do is to show that the potential presence of pollution could make developing the site difficult. That's not a very high bar, but we've seen people come in, including in the tax credit sale market, and suggest that pollution that isn't any greater than you'd find naturally in your backyard is enough to allow a bonus credit. The market is not tolerating that. Next slide. A tax extenders bill is possible in a lame duck session of Congress before year end. Congress is expected to come back into session November 14 and then go until close to Christmas, probably. It has to return because the federal government will run out of funding past December 20 unless some sort of continuing resolution is passed. And then more money is needed for hurricane relief. There is pressure in the lame duck session, or there will be, to deal with some tax extenders issues, like restore the depreciation bonus to 100%, ease up on limits on interest deductions, and deny Section 45X tax credits, which are credits for manufacturers, to manufacturers who have ties to China. Next slide. Billy and Andy will talk about their experience in the tax credit sale market. Just giving you ours, we've seen the market ramp up rapidly, and prices peaked last year, as far as we could tell, at 97 cents per dollar of tax credit, and then dropped back down largely into the 91 to 93 cent range. And they've been moving up again since late spring or early summer. If you're thinking about what you can pocket if you're a seller, put in your pocket, you have to subtract broker fees, tax insurance premiums, and transaction costs from the sales proceeds. We're seeing PTCs traded a premium to ITCs, usually about 1 cent, although we've seen as high as 3 cents. And we're not seeing much differentiation in prices among different types of tax credits. There's some exceptions, but for the most part, no. We just did see last week a deal that was proposing 98.5 cents per dollar of tax credit, but one of the concerns there is there was a dual transaction, and part of what was supposed to be priced for the other asset being sold may have been moved into the tax credit column because sales proceeds for tax credit sales don't have to be reported as income. Next slide. Transferability has opened the door to a lot of new financing options. And here again, I think Andy and Billy will touch on some of these as well. But what we're seeing is, number one, is banks are making bridge loans against future sales proceeds. And the market is coalescing around 70 to 75% advance rates, assuming the tax credits will sell for 90 cents on the dollar. Interest is 212.5 to 350 basis points over SOFR, a floating rate. This is before you have an actual tax credit buyer you can borrow on this basis. Once you have a buyer locked in, well, then the amount you can borrow may increase or the interest rate may come down. Next slide. In some hybrid tax equity partnership deals, these are about 80% of tax equity in the solar market has been partnerships, and 100% in the wind market, are close to 100. So almost every partnership since August 2022 when the IRA passed has been a hybrid where the tax equity investor can direct the partnership to sell some or all of the tax credits. What we're seeing lately is some sponsors, instead of the tax equity investor arranging a sale of tax credits that otherwise go to it, some sponsors are arranging the sale and keeping the proceeds, whereas the tax equity investor might get 5 or 10% of the tax credits. The other 90 or 95% are retained effectively by the sponsor by having the partnership sell them and then pocketing the cash for the sale. Next slide. Blackstone, HASI, Build More Renewables, KKR, Goldman Sachs, Brookfield, Captona, and at least this should be 6 other investors are offering to form cash partnerships with developers to facilitate tax basis step-ups when ITCs are sold in order to claim a larger tax credit. Some of these cash partnerships have been taking a more aggressive turn lately, with the cash investor taking only 1% of income and loss from the project while putting up 20% of the cash to buy the project company at a higher price than it costs to build, so that the tax credits can be sold on that higher price. Most of these cash investors want not only their cash investment back on a preferred basis, plus a yield, which may be as high as high teens, but they also want 40 to 65% of the cash sales proceeds from the eventual tax credit sale. Next slide.
Keith, one question there. We've also seen many providers offering these cash equity solutions, and we're working through a few transactions right now, but I'm curious, are you seeing a lot of these deals closing? We do note that these partnerships can be complicated.
I wouldn't say a lot. We are seeing some. At the start, the tax credit buyers were a little uneasy about whether the partnerships would be respected. I think they've largely gotten past that. Next slide. A creditworthy parent of the tax credit seller must guarantee the buyer that if the tax credits are disallowed, that the buyer will be reimbursed. And at least usually you have to, if you're a seller, you have to show you have a creditworthy parent who can stand behind this. But at least one bank is offering to act as the guarantor for a fee for sellers who don't have a creditworthy parent, and then underwrite the tax credit sale in exchange for a share of the upside if the tax credits can be sold for more than the underwritten price. For example, the underwritten price is 90 cents. This bank will take the tax credits at that price, but if it can sell for more, it wants half the difference. Of course, tax insurance can also substitute for guarantee. Next slide. ITCs can't be sold unless lenders agree not to foreclose during the first 5 years after a project is completed, or unless the debt is moved above a partnership. Some sponsors are forming 9811 or 9451 internal partnerships. They own all the partnership interests, but the debt is pushed up to the 98% partner. That partner gets 98% of the cash and just 1% of the income and loss. Next slide. Appraisers are assigning higher values to projects that qualify for bonus tax credits. So if you're selling an ITC and you're using one of these cash partnerships or even a tax equity partnership to sell the project company near the end of construction to move it into the partnership with a higher value on which the tax credits are calculated, the appraisal is key. You would pay more for a project on which a 50% investment tax credit can be claimed than one on which only a 30% one can be claimed. This is being reflected in appraised values. It's causing heartburn for the big tax equity investors who had been capping step-ups at 15 to 20%. Some tax insurers won't insure a basis step-up above 35, and the tax bar is watching a U.S. Claims Court case closely that's expected to go to trial next spring called Alta Wind. The IRS isn't so pleased about people claiming tax credits on tax credits. That's at issue in this case. Next slide. So finally, I'll mention a couple mistakes we're seeing tax credit sellers making. Next slide. One is just unwittingly changing the tax characterization of the entities in the ownership chain on the seller side. For example, where entities are moved around in anticipation of financing, you may find the one entity turns into a disregarded entity, or it turns into a partnership or a corporation or whatever. The characterizations, the labels you put on these entities for tax purposes changes. And if the tax credits were sold during the year, the project owner for tax purposes may have changed. And so the wrong party signed the tax credit sale agreement. There could be a short tax year. If the character of the entity changes, its tax year may end. There are deadlines to make sales after the tax year ends. The wrong entity may have registered the sale in the IRS portal. Next slide. The other mistake we see people doing is for smaller tax credit sellers. If they have individuals, S corporations, or closely held C corporations as owners, they may not be able to sell all of the tax credits. They wouldn't be able to sell them to the extent of ownership by those types of entities if there is any non-recourse debt on the project to which the tax credits relate. So there's a section 49 of the US tax code. These are at-risk rules. Anybody with non-recourse debt in the ownership chain, plus these types of owners, would have to try to structure the non-recourse debt so that it fits in one of two exceptions. They're not easy to work with. That's it, guys.
Great. Thanks, Keith. Well, I'm sure that will spur a lot of questions and excited for the Q&A at the end here. But before we get there, we'll go through a few slides from Reunion's Q3 Market Intel report. We'll kick it off with everybody's favorite topic, which is pricing. I think it's no secret that pricing has risen across the board towards the end of 2024, driven by supply and demand. On the one hand, there's been an influx of large tax credit buyers that have entered the market in the second half of 2024. And at the same time, the number of remaining opportunities has dwindled as the year has progressed, which has resulted in a lot of competition amongst buyers to secure the scarce remaining 2024 opportunities. One of the biggest surprises has been a significant increase in pricing for large investment tax credit opportunities, so the green line at the bottom, as Keith mentioned, starting in early summer Q3. I think there's a few factors. First, early in the year, buyers were hesitant in general to purchase ITCs because if you buy an ITC in Q1 or Q2, you're essentially prepaying all 4 quarters of your taxes. And there's just a limited subset of buyers that are willing to do that. So we saw deals getting done in Q1 and Q2 for 91 cents or 92 cents. As the years progressed, we've seen buyers get more comfortable with the cash flow impact of ITCs and just more buyers wanting to get that large deal done. So in Q3, we did see a few opportunities where, there was a bid and multiple buyers bid 95 cents or even slightly higher for ITCs in the $100 million range. I will note that in this case, in a couple of these cases, the sellers were investment grade, which we do think makes a difference. But nonetheless, these types of transactions have driven up the green line for our forecast on pricing for ITCs in Q4. Compared to ITCs, the Section 45 and 45X credits typically trade at a smaller discount because they do not carry recapture risk and in general are more straightforward to diligence. We have observed that pricing for 45X credits, the yellow line, has almost converged with Section 45 production tax credits around the mid-90s per dollar of credit. We think that for 45X, a large driver here has been that we've seen more and more sizable 45X transactions from creditworthy sellers. And these types of deals just carry a premium price, which has driven up the price on 45X. Section 45 production credits were always in high demand from the beginning of the year. And so even early in 2024, those were trading in the mid-90s. One final thought is we do think that this uptick in pricing at the end of 2024 is a seasonal trend, and 2025 is a different ballgame. At this particular point in time, we do think there's actually an oversupply of 2025 credits. So there's more opportunities out there than buyers that are willing to enter commitments today. So we've been telling all of our buyers it's a great time to start looking now at credits to avoid this end of year rush that we're dealing with right now. There are lots of credits available for 2025 with different sort of technologies and risk profiles. Next slide.
Thanks, Andy. We have observed that the biggest predictor of relative pricing is credit size. There is a direct correlation between size and pricing across all different credits. Tax credit buyers typically want to enter into 1 or 2 transactions to satisfy their entire credit need for that year. And the number of very large credit transactions, call it $75 to $100 million and more, is limited compared to the number of deals that have smaller bite sizes. There are some buyers that will do multiple smaller transactions, either to diversify their risk or to get a higher overall yield. But these are definitely in the minority. When you think about a typical tax director or a VP of tax who's looking at these transactions, this is one new aspect of their job. It is not their sole job. So efficiency in transactions is a high priority for them. Next slide.
It's no surprise that the IRA has driven a surge in tax credit volume for 2023 and particularly in 2024, as the chart shows. Reunion is forecasting mid $20 billion of transfers in 2024, and this volume of transfers will grow significantly into the future, reaching $60 billion in the year 2023. We do also understand that virtually all tax equity deals are now structured to allow the tax equity partnership to sell credits, and so that's a structure that's also happening often in the market. Next slide.
The transfer market continues to mature and become much more efficient. We did an analysis of the elapsed time between term sheet execution and to closing and found a very clear downward trend. Most of our transactions today close within the exclusivity period of a term sheet, which is negotiated typically between 30 and 60 days. There are certainly outliers, but on the whole, the transfer transactions are unambiguously faster than a traditional financing, whether it's a tax equity deal or a non-recourse financing. Next slide.
Buyers we work with in general are very sensitive to above-the-line expenses because any additional expenses incurred by a tax department are typically heavily scrutinized. So as a result, most buyers do look to pay a single all-in price for the tax credits, which Keith alluded to earlier. So if tax credit insurance is present, typically the seller will pay for that. If there's an intermediary such as Reunion working on a deal, seller will also typically pay that fee. And one trend that we've seen very sharply is that buyers are increasingly requesting reimbursement for both legal and due diligence expenses. Our observation is sellers generally are agreeable with this so long as the reimbursement is capped at a reasonable level. And what reasonable is varies quite a lot depending on the transaction. We've seen a pretty wide range. I'd say as low as $25,000, but going up to $250K or even slightly higher. Next slide.
So maybe some other commercial trends just to tick off really quickly. One, the level of due diligence required by buyers still varies widely. What we found is buyers have different expectations and requirements. Some are willing to do confirmatory due diligence and really rely mainly on the seller indemnity and or insurance. Other taxpayers we've found really want to make sure that they have what we call an audit-ready due diligence file that they believe will suffice in the event of any type of IRS inquiry at that stage. Secondly, deal complexity is not strongly correlated to deal size. You would think the bigger the deal, the more effort involved. What we found is there really is no correlation in deal size. There are other correlating factors. In fact, some of our largest deals have been the most straightforward, and some of our smallest deals have been the most complex, involved, and time-consuming. Third, the market continues to be fragmented. On the next slide, Andy will give a little bit more color about the buyers. But on the sell side, we are year two. We're 2 years into the IRA and seeing new projects and manufacturing facilities being completed that were created really as a direct result of the IRA. So we expect to continue to see a lot of net new tax credit sellers enter the market in coming years. So more and more tax credits being generated. This is very exciting and certainly reflective of the policy intent of Congress. Finally, there's always been a lot of talk about basis step up, and there continues to be a lot of focus on basis step up. I think we've seen that the large tax equity banks have had historically a certain policy about the amount of step up. And anecdotally, we're just hearing more and more scrutiny from insurers. And we think there's a decent chance that there could be some sort of informal ceiling on basis step ups that may emerge in the near to medium term, really driven by these carriers, where there is a basis step up and not a very strong seller. There's almost always insurance, and that insurance, those insurance carriers will dictate a lot on what is and is not acceptable on these fair market value step ups. Next slide.
So one of the goals of the IRA was to expand the pool of investors supporting the clean energy transition. And we're very excited to see so many buyers from virtually every industry enter the market for clean energy tax credits. I think one observation is that very, very large taxpayers have mobilized perhaps more quickly than we anticipated because the size of the prize is just really large. If a large buyer is purchasing a $500 million credit purchase and saves 5%, that leads to $25 million in additional net income, which for any publicly traded company is a very big deal. So I think we've been surprised at sort of how large, how quickly, top 50 US taxpayers have really mobilized to purchase credits. Some other general observations: companies that are consistently profitable are able to move more quickly and confidently in purchasing credits. I think at the end of the day, it's less industry dependent and really more about how each individual tax team and their leadership and board of directors is willing to move into this space. Next slide. In terms of the type of credits and technologies that we're seeing, we did an analysis based on the number of transactions, and what you can see here is quite a large amount of transactions across 45, 45X, and 48 credits. In terms of volume, 45X is the fastest growing credit in the market and is particularly attractive for these large taxpayers I mentioned. It is difficult to find single ITCs or PTCs that deliver more than 150 or $200 million in a single year, whereas we are seeing 45X transactions that can deliver 500 million or even north of $1 billion in a single transaction, which is very attractive for large taxpayers. Next slide.
So insurance, we always have to talk about insurance. Insurance has unequivocally played a key role in the tax credit transfer marketplace. About half of the transactions in our data set involve insurance. And frankly, personally, we've been pleasantly surprised at the overall responsiveness and flexibility of the insurance carriers as a whole. We closely monitor the insurance market and make sure and hope that the insurance market remains deep and robust. Any large retraction by the insurers would have really an immediate and chilling effect on the overall transfer market. So right now it is still a very deep and liquid market, and we hope it stays that way. As a side note, we typically see that tax credit deals with insurance require the buyer to first recover any losses from insurance first before pursuing indemnification against the seller. Insurance in that way is a great enhancement tool for a buyer, but also provides utility to the seller by protecting its balance sheet from potential losses. So the insurance product is dual purpose and definitely provides value to both counterparties. Next slide.
And Billy, one question that came up, in what situations do you recommend buyers to require tax credit insurance?
Yeah, I mean, I think the obvious use case is where the seller does not have a strong balance sheet to provide that indemnity. Also, I think insurance is very valuable in the case where there is some subjectivity. So some areas where it's not black and white. So we talked a lot about basis step up, but Keith also mentioned energy communities where there are some folks who are using the brownfield qualification, and that is entirely subjective. It's not like the census tract based energy communities where you just put the location of your project into a map and see if it qualifies or not. So those subjective areas where there is you're never going to get a clear answer from anyone. That's a very great place where insurance helps out.
Great. Well, this concludes our formal presentation. So we'll now move into the Q&A section. I see we already have a couple dozen questions here, so we'll try our best to get to as many of them as possible. I think to start, we do have some questions around some of the partnership structures, both cash equity as well as tax equity. So maybe I'll start with Keith. How would you diligence one of these cash equity partnerships, since they seem to be popping up everywhere and there's some variation in how these are set up? What's your playbook for getting folks comfortable with the structure of these partnerships?
Well, I'd want to understand the economics, and some of the cash investors are reluctant to share much information about it. So it can be a challenge. There are two ends of the spectrum. There are the ones that feel like tax equity partnerships in the sense that there's a real contribution, 20%. There's the cash investors taking 20% of income and loss. And there are others that are pushing the envelope. This is the pattern in structured finance markets. They always push the envelope until they go too far. So I'd understand the economics. That's where I'd start. And then you just have to, it's a gut check. You just have to talk to your tax counsel.
Yep. And I guess flipping over to tax equity partnerships, if a buyer is considering purchasing credits out of a tax equity partnership, what are some of the terms that they should pay attention to?
Well, let's see. I think on the buyer side, one is whether the partnership is retaining any of the tax credits, because some people read the IRS regulations on tax credit sales to say that any IRS adjustment will come out of the tax credits that are retained by the seller first before the IRS goes after the buyer. Second thing I would understand is the contest rights. What in what circumstances will you have to involve the seller in any IRS proceedings? And how much latitude do you have to drive that yourselves, or are you just effectively turning it over? I'd say those are the two largest issues for the buyer that are just by virtue of buying from one of these partnerships. I'm sorry, there's one other one. We found the sponsors who have already done tax equity deals and agreed to pay the legal fees of the tax equity investor sometimes are reluctant to pay another set of fees when a tax credit buyer comes in. And they also want to limit the amount of diligence that the buyer can do, given that the tax equity investor has already done full diligence. So I think as a buyer, there are certain types of diligence that you do have to do. You have to understand any gaps in risk between what's the indemnity is offering the tax equity investor and what you're being offered. So those are the places I would focus.
And Keith, just to follow up on that, we're seeing kind of the norm, especially on the larger tax equity deals, where the Class A tax equity investor doesn't want to encumber the partnership with any indemnities. So basically, it's the tax equity saying you can sell your credits and get value for them, but we're not taking any additional risk. And the Class B member or the affiliate of that sponsor is the one that is providing the indemnities. Is that generally what you're seeing as well?
Yes, what you described is pretty typical, where the buyer is told it cannot bring a claim against the partnership directly or against the tax equity investor. It has to go after the insurance first, and then second against the sponsor partner. And there may be a cash sweep of cash that would otherwise go to the sponsor partner that can also be used to pay these indemnities.
Got it. Very helpful.
Why don't we shift to basis step-ups, since I see a lot of questions on basis step-ups. I'll start with Billy. If a developer has a large step-up in cost basis, how should they prepare to take their project to market?
Yeah, so I think in general, like anything else, I think doing your homework and making sure that you have a strong case on what that step up, how to defend that step up. So obviously getting a good appraisal from a reputable firm. Secondly, making sure that the structure in which that you achieve that basis step up is strong, defendable. And then ultimately it's going to the insurance markets. I think there's still a decent appetite for buyers to look at deals that have step ups. But there is generally the assumption that they will be insured. So doing that pre-work, engaging with a broker, insurance broker, to make sure that the markets will accept it. What we're seeing come up in some deals is the insurance carriers will accept the deal, but also slap on a retention, which is basically a deductible. So even if you have a retention and that retention is in the policy, that's pretty bad, because basically if you have $1 million or $2 million retention, basically the buyer would be on the hook for the first $1 million or $2 million of losses, which really kind of obviate the value of insurance. So structuring that properly takes some work and takes some effort up front.
Bill, Andy, can I add to that on just looking at it from a buyer's standpoint? The Treasury has tended to focus on the price per watt rather than the percentage step up. So does it just feel like it's in the range of what the Treasury is seeing in the market? Second, as far as the appraisers, we looked at 400 appraisals in the last 4 years in the solar market and did analyses there. The more conservative appraisers are the ones who take the lower of two methods, depreciated replacement cost and discounted cash flow, after-tax cash flow, and treat that as the value. Focus on that. What's the method? And focus on the discount rate. The more aggressive appraisers are down at 6%, 6.5%, given where interest rates are. And then finally, look at the appraisal carefully, because a lot of them have embedded in the replacement cost calculation a developer fee. So they're kind of building the step up automatically into the appraisal. I think that's common, so it'd be rare not to find that, but focus on the amount of the developer fee.
Yeah, that's a great point to highlight. One follow-up, Keith, on that. Are all basis step-up amounts created equal? I mean, you did allude to the dollar per watt being the ultimate arbiter of whether it's excessive, but if a developer works on a project for 12 to 24 months and puts real work into a project, does that justify a larger step-up versus a developer that just purchased a project at the last minute and flipped it?
It does, plus riskiness of the development process. I know from lots of discussions with the Treasury over the years, they put out a paper in the summer 2010 or 2011 that suggested a 10 to 20% step up would be normal. But they quickly walked that back and then started taking the position that since historically before there was a reason to step up, developer fees were on the order of about 3%. That they would not normally go above 9% unless there was a story behind it. It's a very risky process, a long process where a lot of capital was at risk.
Yep. We have a question about the future market. So we've talked a lot about ITCs, PTCs, 45X credits. I guess, Keith, from your vantage point, what do you think is the next large category? Is it carbon capture? Is it hydrogen, nuclear? What's coming down the pike?
Well, we've been doing a lot of nuclear, and these are in the $1 and $2 billion range. And what's interesting is the prices for nuclear credits have been in the mid 90s. So no differentiation. We've done some 45Q. They tend to be priced a little lower. I just think that market is moving slowly. So I agree with your assessment, 45X, now that final IRS rules are out on 45X, see more of that. Nuclear just because it was slower to get going. Offshore wind is another category, although those tend to be just absorbed by large tax equity investors.
Yep. We have a question here about sort of future commitments. So if buyers are willing to commit, which we don't see very often, but if they're willing to commit today to credits that will materialize in 2026 or 2027, what kind of discount are we seeing? Billy, do you want to answer that one?
Yeah, so it's a good question, and one that there's not a great answer for because there are fewer data points. One of the maybe challenges that has emerged in transferability is the fact that the vast majority of tax directors, even if they work for companies that produce taxable income every year. Their field of vision is typically the current tax year or the one that just kind of finished. So so right now people are still focused on 2024. They're starting to look at 2025, and that causes a challenge for especially developers of large capital heavy projects that want to that need financing to build the project, and that might take another 18, 24 months. So what they are left with is going to the financing markets, which, as we've talked about, and we agree with Keith that, right now, kind of the traditional underwriting for an uncontracted tax credit is called, 70 cents on a 90-cent type of price. So mid 60s advance rate at an even higher interest rate level than your typical contracted bridge loan. That leaves 35% of the tax credit value that is really needed to be plugged with equity, which is obviously going to be very expensive. We don't see the financing markets moving that much beyond that. It seems to be that's a pretty sticky term at this point. So, we're thinking about lots of ways to bridge that gap. And that I think will be a pretty exciting area of focus in the next 12 months. But yes, right now we do have that time challenge that some of these larger developers are presented with.
Yeah, that's right. And I think, I was at a recent conference where I did mention sort of 2026. A lot of developers, great developers, are looking for commitments on 2026 opportunities. And, I think that might be an area that tax credit buyers and tax directors just haven't thought of. And I think as the market matures, certainly if there's buyers out there in the universe that are looking to make an earlier commitment in exchange for a deeper discount, that's a very interesting conversation to have.
Maybe some quick ones. And Keith, any estimates on when the nuclear regs will be finalized by the IRS?
We're expecting them by year end, but as to when, no, they tend to drop on Friday mornings.
Got it. One question was, have you seen any tax credit transactions in the context of repowerings? That is actually something we've done a number of. We definitely think that the repower market is one that is kind of going to be one of these pretty big areas going forward. A lot of projects have now come off their initial 10-year PTC window. They want to repower, and typically what we would see is an appraisal to satisfy the 80/20 test. And that appraisal, it can be developed by a lot of the same guys who are doing the typical ITC valuations, but that is a normal approach, and we are seeing a lot of those transactions.
We have a very good question here that's a typical one we hear, which is, if you have tax credit insurance, do you still require an indemnity or guarantee from the seller, and what does that cover versus the tax credit insurance?
I mean,
Go ahead, Billy. Go ahead.
Yeah, maybe I'll give my thoughts and Keith chime in. The insurance can be a substitute for a parent guarantee. So sometimes you provide insurance in lieu of a parent guarantee. It is typically not a replacement for an indemnity. So to the extent that there is insurance, there are still exclusions of coverage, and to the extent there is a loss that is an exclusion to the insurance policy, the buyer will still want to go to the seller to recoup their losses.
Well said.
Glad I got that right.
We have another question here that I think would be good for Keith, which is around qualification requirements for start of construction. So the person is wondering if there are any indicators or kind of ways to ensure that the start of construction documentation will be respected.
There are two ways to start construction currently. We ran an ad at an industry conference years ago. It was a dog digging a hole, and the caption was "under construction?" It doesn't take much, but the two are to start physical work of a significant nature on the site or at a factory on custom-made equipment. And the other is to incur at least 5% of the project cost. You don't incur costs merely by spending money. Generally, you incur them by taking delivery of equipment or services. With one exception, you can make a payment at year end and take delivery within 3.5 months after the payment and count the payment date. There's no guarantee, but we haven't seen much. I'd say the issues around starter construction at the moment are what qualifies as custom-made equipment if you're going to rely on physical work. The market's comfortable with transformers just because the IRS said they work. When you go beyond that, you can get a debate. Next year, starting construction may be important to grandfather projects for any change in tax law. And there, what counts as the start of construction may be tougher. Historically, it's been signing a binding construction contract to be exempted from change. For example, when the ITC was last repealed in 1985, end of 85, you had to have a binding construction contract. If I'd pay attention next year, try to focus on being able to prove that you had committed to an investment based on the existing incentives, because when transition rules come out, you're not covered. You go into the Joint Committee on Taxation, describe your case. If it's warranted, they will often fashion a rifle shot, they call it. It's a transition rule that applies to one project.
Great explanation. We have a few questions here about how often claims happen, how often there is, a claim against insurance that's triggered. I'll start by saying, recapture is something that's often talked about. I think in the history of, tax credits for solar, there are very, very few instances of a wholesale recapture of credits. We have seen some activity around the basis step up, and sellers that have gotten a little bit too overeager with the amount or the valuation of the basis step up, and that's triggered some judgments. But I'll let Billy and Keith opine on other situations.
Well, I looked during the Treasury cash grant era, where virtually every project was audited before receiving the cash equivalent of the tax credits. About 27% of solar projects suffered some sort of reduction, generally because of the Treasury's view that the basis was inflated. As far as insurance claims, we did run an article in the Project Finance Newswire. I had Aon pull up its data. There was a surprisingly large number of claims on reps and warranties insurance, really on the order of 18 or 20% on policies had claims on them over about a 3 or 4 year period. You can find online, if you put in RWI insurance claims, Norton Rose, there should be some data on that. Most common source of a claim on RWI, which is a broader form of insurance, tax insurance is a subcategory, were 10b-5 misrepresentations about the financial status of the seller.
I have one question for you, Keith. I think in November of last year, Treasury came out with proposed regulations on the ITC, and one of them was on retrofit energy property, where you have an existing energy property, you add more CapEx to it, and traditionally you could basically take ITC on that new CapEx. The Treasury basically indicated now you have to hit the 80-20 rule. And I've heard surprisingly not a whole lot of, industry whining about this, but I'm curious if you have a view on whether that retrofit energy property is going to survive final regs, or has there been enough kind of pushback in the shadows on this term?
I was surprised too. I expected more pushback. There wasn't. The Treasury showed its hand. It issued additional regulations on the tech neutral credit. These are the tax code sections to which PTCs and ITCs move after this year, and it had the same rule on that. So I think it's almost a foregone conclusion You will not be able to claim ITCs on later improvements to existing projects unless they are so extensive that you're considered to build a new project.
Got it. Very helpful.
I think we have one last question here that I think is a pretty good one to end on, which is, are you seeing different pricings for asset classes? So whether that's resi versus distributed generation versus utility scale in solar, and similarly, do you see different pricing if there are more adders, such as domestic content or energy community?
There may be a slightly lower price for residential rooftop solar, just because it's so hard to get one's arms around it on diligence. But in general, there was a lot of differentiation last year when the market first started. There were different pools of liquidity around different types of tax credits. We're not seeing that this year. Perhaps 45Q credits are an outlier. And then just the size of the transaction. If it's a large transaction is a whole little differentiation, but large versus small, there would be.
Yeah, I think that's right. I mean, our observation is that for every opportunity, there's a separate supply and demand based on who's ready to buy and who's selling at that given time. So certainly we've seen pockets of time where, for example, there's less demand for renewable natural gas and there's more buyers that want your traditional solar, wind, battery storage. And there's also times where, there just happens to be a lot of buyers that are looking for $50 million tranches of credits. And they're just, those can get bid up if there's a lot of competition. So I think supply and demand definitely drives each of these categories in pricing.
That's a sign of an efficient market to which you've contributed with your platform.
Thank you.
Appreciate that, Keith.
All right. Well, I think that, are there any final questions here? I'm surprised nobody's asked about prevailing wage, actually.
Well, I think maybe one final observation from us is that prevailing wage will be kind of a very interesting area of diligence, and where similar to basis step up, I don't think there is a norm or a typical underwriting package. We've done some deal with prevailing wage where the insurers were very flexible, and we're doing some now where there is a fair amount of rigor. I think we also need to just keep in mind that there is a pretty favorable cure period. I don't think the IRS is trying to find ways or reasons to reduce the credit from, say, 30% to 6%. They do really want this the goal of this piece of legislation to be to really make sure that everyone's getting a fair wage in the end.
I think what you don't lose the tax credits due to prevailing wage problems, with one exception. You just pay a penalty. And the number of workers who are on these sites is not that many. So we see caps on the liability of the sponsor. They're low, but they're not troublesome just because of the limited number of workers on the site during construction. The one exception is where there's just no records to track down workers. You don't know how many there were, and that's the wild card.
Yeah, definitely.
Well, I think we're at the top of the hour. So thank you, Keith, for joining us today. This was a fascinating discussion, and really enjoyed hearing your insights. And thank you, everybody, for joining the webinar today. It's been great to interact with you all.
Thanks for having me.
Thanks very much.